fundsupermart.com.
What is your outlook on global equities for 2013?
We're still cautiously optimistic in terms of markets, and after a pretty strong run last year in 2012 where markets went up nearly 20%, we will not be surprised to see a bit more moderation in terms of gains. But if you look at events around the world where there's a huge amount of liquidity sloshing around the world, and also seems to be that sentiment to equities market has been improving. We would not be surprised to see a bit more inflows into this particular asset class. Yeah.
What are some of the key drivers for global equities?
Let's start from the different areas of the world. If you actually look at the US, we've just passed the fiscal cliff, and that was a cliffhanger, if you put it mildly, and it was right to the end. And the next big event in the US will be the debt ceiling, which again, if you track the news flow that is actually happening in currently, you will see that both the Republicans and the Democrats have very wide expectations in terms of what the package is going to be. So that's number one. Number two is in terms of uncertainty would be, I guess, China. They are still going to engineer a slower growth, and let's not forget that in a couple of months' time, the new leaders will come on board, and there are signals that they are trying and revive the economy. But there are plenty of issues in China, whether it's the shadow banking issue in China, or whether that's their ability to try and migrate from an export-led economy to a more consumer-driven economy, and that experiment or the transition remains to be seen in terms of whether it's going to be successful. And then you look at the other big pieces where Europe continues to be a big question mark. I mean, we saw Germany recording not so good fourth quarter GDP numbers. But the good thing, if you actually look at the silver lining of despite all these issues, is that the rebalancing in Europe has started, where some of the Mediterranean countries, or we call it the Club Med countries, whether it's Spain, Greece, you are seeing a bit more stability. We're not seeing as much bad news as we originally saw probably a year ago. The economies will continue to chuck along. It has to restructure itself. But that's a good thing. It is finding its footing, and the European powerhouse, which is Europe, you will see them also trying to adjust accordingly to the new reality, where they have been also funding a lot of the I guess a lot of the budget deficits in Europe. But the rebalancing is healthy. I think, from a real economy standpoint, it's not going to be an overnight solution to this. It will take time. But if you look at the companies level, which is what we do, we are pretty much a bottom-up stock picking house. Whether you look at Asia, whether you look at US, whether you look at Europe, you will see that all these companies are in a very strong financial position. In fact, they have pretty strong, solid, fortress-like balance sheets. And they are trying to put some of the excess capital to work, and it is only because of the uncertainties in the market that they are less confident in doing so. For example, in the US, a lot of corporates you see have been saying that no, they do want to expand, but because of the uncertainty of the fiscal cliff that has actually impeded their whole strategic implementation. So with a bit more certainty in terms of, I guess, on the political front, on the macro front, you will see companies will continue to invest and expand. So the good thing is corporates continue to be in a solid position, both in terms of their balance sheet and also the ability to execute growth. So all in all, that's the thing that we are seeing that is going to be driving equity markets will be, one, there will be still a lot of liquidity sloshing around, and a lot of money has actually gone into the bonds market. But if there's seen a bit more stability in terms of equities market, or you see that there's the risk reward from bonds and equities becomes wider, there will be a shift. They're actually seeing shift from bonds to the equities market. So that's one, where a lot of liquidity and movement from bonds to equities. And finally, I guess corporates would be the big driver in terms of corporate earnings, in terms of ability to navigate. And we are pretty sanguine in terms of, I guess, global growth. US is finding its footing in terms of the GDP growth, and you see housing prices stabilizing. In fact, some markets you're seeing house purchases increasing. Banks are lending again. Even some of the national banks, the Wells Fargo of the world, are putting a lot more emphasis on mortgages. So there's plenty of things to be excited about, despite a lot of gloomy news in terms of what you've actually seen in the news.
What are the headwinds that the global markets face?
I think the headwinds is, I guess it's more a black swan scenario where, whether it's a war that's going to happen, whether, there's a lot of geopolitical issues, not just in the Middle East, but also in Asia as well, where you see China and Japan fighting over the islands. There's also the Vietnam side with China. So there's geopolitical risk is obviously number one. The second one would be just, I guess, not resolving some of the things that we expect them to resolve, like the debt ceiling thing. We expect there will be an agreement of some kind, but if there's no agreement, that potentially could derail the confidence in the market. As stands, we are already hearing news that, because of the divide between the Democrats and the Republicans, there is a potential that the debt ceiling would not be agreed upon in time. The biggest overarching issue in terms of headwind would be just, global growth is not coming through, and that can be various drivers, whether it's China, Japan, or Europe, or even US.
Which are the countries or sectors that you are paying closer attention to for 2013, and why? It's a tough question to ask, and probably unfair to us, because we are not really a top-down house. We look at companies, and if you seen how we invest in companies, we will try and buy good quality companies with solid management that's able to react to issues out there in the market. But if you can see that, in short, you will see that 2012 was a market where stock market was strong on the defensive names, whether it's consumer staples, some of the telcos, and these names have actually run pretty hard. And from our perspective, we probably less excited in putting more money into things that have actually run very hard and valuations are expensive. We probably like to put into things that are more, I guess, they have not run as hard, whether it's
the property market, whether it's some of the banks, what are some of the consumer discretionary names as well. So these are the things that we focus on, but we pretty much not take a top-down view in terms of sectors, but from a valuation standpoint, if you actually look at the different sectors, there's actually much more opportunities on some of these sectors that I mentioned earlier to actually re-rate itself. If you look at from a global perspective, some of our big overweights will be in Latin America. We have a bit of overweight in Europe, we're underweight US, and we're probably quite neutral in Asia.